what is the underlying. So an underlying can be a stock, an index, interest rates, currencies, or commodities. Strike price is the price at which the buyer of the option wishes to buy or sell that particular underlying. The expiry date is the date on which the contract expires. So what are the different types of options? You can classify options in two ways. The first is when they expire, whether they expire at the end of every week or at the end of every month. Right now on NSE, we have the index options that expire weekly and the stock options that expire monthly. Secondly, you can classify the options based on whether you are betting on the upside or the downside of the markets. For example, if you believe that the markets are going to go up, you are likely to buy a call option. If you believe that the market is likely to go down, you are likely to buy a put option. Let's say you want to trade Nifty option and Nifty is trading at, let's say, 12,000. You believe that Nifty is going to go up from here, so you buy a call option of 12,000 strike price at, let's say, 100 rupees. If you are buying this call, you have the right to buy Nifty at the rate of 12,000 on or before the expiry. The expiry, as we discussed, is on every Thursday of the week. So let's say you buy this option on Monday. So you have 4 days, Monday, Tuesday, Wednesday and Thursday, for this option to move higher and make you some profits. Let's say it's the expiry day and the market closes at 12,200. Now we had the right to buy the option at 12,000, but we paid 100 rupees for it. So our break even in this case is 12,100. So unless prices move above our break even, we are not going to make profit. So basically above this is our profit zone and below this is our loss zone. So when the market closes at 12,200, our call option will be worth 200. Subtract the initial buying price from that and you get 100 rupees as your profit. So that is how a call option works, and a put option works in the exactly opposite manner. Now let us go back to our call option example and see what if the market does not move and closes at 12,000 itself. So here the market does not go to 12,200 or 100 but closes at 12,000. In this case, our option will be worth 0 and you reduce the cost or the purchase price of 100 from it, you are left with a loss of 100 rupees. So not only does the market has to move, but it has to go beyond your break-even point in case of options for you to make money. If you compare this with simple futures example and you bought the futures at 12,000 and if it goes higher than 12,000 you make profit, if it goes below 12,000 you make a loss, but not in case of options. In case of options things are a little different, and here your underlying price has to move beyond your break-even price. So for call option your break-even is the strike price plus the call option premium, and in case of put option your break even is the strike price minus the put option premium. Alright, let us move on. One question that I always get is whether I should buy a call option or a put option. So if you are betting on upside, obviously you need to buy a call option, and if you are betting on a downside you need to buy a put option for a given set of conditions. Like let's say that is Nifty is at 12,000, and if you compare the premiums of call option of the 12,000 strike price and the put option of the 12,000 strike price, you will find out that the put option premiums are always greater than the call option premiums, all other things remaining constant. Now why is it so? Just recall the last instance where you were long and market fell sharply. Remember the feelings and emotions that rush through your mind when that was happening. You would agree that traders fear downside more than they like the upsides. If the market gaps up 100 points, nobody is worried as much as when it gaps down 100 points. So the emotions and fears are stronger to the downside than to the upside, and that is why when an option seller is pricing an option, he will add more premium for the downside possibilities than to the upside possibilities. The option sellers will factor in more risk into the premiums of put options than they will in the premiums of call options. Now, one more question that is regularly asked is, what is a deep in the money option? As we said, an option depends on many things. First is the underlying, let's say that is in our case Nifty, and which is trading at 12,000. Then we select the strike price. Let's say we select strike price as 12,000. We will talk about calls. So strike prices above the current market price of Nifty, in this case 12,100, 12,200 and so on, are considered as out of the money strike prices. Whereas if you go below, that is 11,900, 11,800 and so on, any strike price below the current market price for a call option is called as in the money. So above the strike price, a call becomes out of the money. Below the strike price, a call becomes in the money. Put options are exactly opposite to that. So any strike price that is above the current market price for a put option will become in the money, whereas any strike price that is below the current market price for a put option will become out of the money. When you talk about deep in the money options, whether it is call or put, in case of a call, it will be way below the current market price. So let's say someone is buying a call with the strike price of 11,200. This is an deep in the money call option. Similarly, if someone is selling, let's say 12,800 put option, this put option will be deep in the money. So what are the advantages of deep in the money options? First and foremost, they have a very high delta. Delta tells you how much an option will move for a given movement in underlying. So for at the money options, the delta is always 0.5. And for deep in the money options, the delta values are very close to 1. And if you buy deep in the money option, you can replicate the action of futures or a stock by buying deep in the money options. Second benefit of deep in the money option is lesser time value. Now what is time value? Let us go back to our whiteboard. We discussed underlying price, then we discussed strike price, then we saw option premium. Let's say we are talking about a call and the option premium is 100. How you calculate time value is by finding out this formula: strike price plus option premium minus the underlying price. So if we calculate for our case, let's say the strike price is 12,000 plus the premium is 100 minus the underlying, and you get answer as 100. So for the 12,000 option, call option, which is trading at 100 rupees, if the underlying is trading as 12,000, then the time value is 100. Now let's say, as we said, that if this moves to 12,100, the call option premium goes to 150. In this case, if you apply the same formula, what you will find out is that the time value comes to 50 rupees. As you go deeper and deeper into the money, this time value will go on reducing further. Now, why is it important? Because let's say you bought an option of 12,000 strike price at 100, and at expiry, if it closes at 12,000, this 100 rupees time value will become 0. If you want to replicate a stock or a future and don't want to buy a lot of stocks or pay the margin on future, you can buy deep in the money options, because you will be charged much less than what futures margin is, or buying that much amount of stock will cost. You have to pay much less, and at the same time this time value is also low. So even if your stock does not move much, the time value loss is not that big. There are advantages of buying deep in the money call or put options. All right, so these are some of the basics related to options. I know it gets confusing real fast, but obviously you'll have to stay with me for this whole series and you will start understanding all these concepts one by one. So stay tuned, subscribe to the channel, enable the bell notification, and I will bring a ton of content on options going forward for you. So thank you for listening to this video till the end, and on your screen there are suggestions for the next video you should watch, and I'll see you in the next one.